Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at CAMT, or Camtek Ltd. CAMT is a producer of inspection and metrology equipment for the semiconductor industry. Here's the barchart.com technical opinion rating for CAMT. The bar chart rating is a 100% buy and ranks in the top 1% of all short-term signal directions. Long-term indicators fully support a continuation of the trend. The market is approaching overbought territory. Be watchful of a trend reversal. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that CAMT is well above the moving average line, so the monthly trend in CAMT is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line all year, so the daily trend in CAMT is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. CAMT is below the upper Keltner channel line, so CAMT is inside the buy zone. Since the trend is up, we want to buy a call. CAMT has 4 option chains to choose from. We're going to use the July 19 option chain. Right now, the July 19 options have 40 days to expiration. Here's the CAMT option chain for July 19. CAMT closed at 109.42 on Friday. That means any calls on the list from 50 to 105 are in the money. Let's take a look at the profit potential for purchasing the 110 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 110 call is 6 to 720. We tried to enter at the midpoint, so we'll use 660 as the buy price. Our call option calculator shows the profit potential for this call based on CAMT price changes at option expiration from flat to a 12.5% increase in price. We can see that if the CAMT stock price is flat at 109.42 at option expiration, the 110 call will lose 100% of its value. Ouch, this is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 100 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 100 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the CAMT stock price is up 1%, the 100 call will lose 20.3% of its value. We want that to be break even or better, so the 100 call does not meet our requirements. Let's see if the 85 call will work. The bid-ask spread for the 85 call is 23.20 to 27.90. We tried to enter near the midpoint, so we'll use 25.50 as the buy price. The 85 call works. If the CAMT stock price is up 1%, the 85 call will make a 0.1% or $1 profit. That's better than break even, so the 85 call is the one we'll buy. The call option purchase calculator also shows that if the CAMT stock price increases by 2.5%, the 85 call will make a 6.5% or $166 profit. If the CAMT stock price increases by 5%, the 85 call will make a 17.2% or $439 profit. If the CAMT stock price increases by 7.5%, the 85 call will make a 27.9% or $713 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the CAMT stock price does not make the expected move up and remains flat at expiration, the 105 call would only lose minus 4.2% or minus $108 compared to the minus 100% or minus $660 loss for the 110 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the CAMT July 19 expiration 95 strike call and sell to open the CAMT July 19 expiration 100 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 95 call for $16.70 and sell the 100 call for $13.20. $16.70 minus $13.20 equals $3.50. So the entry price or debit cost for the spread is $350. The call option spread analysis calculator shows that the spread will make a 42.9% or $150 profit if the CAMT stock price declines by 7.5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect a $1,320 cash credit to our brokerage account for the sale of the 100 call. As we said on the previous slide, this reduces the cost of entering the spread to $350. Here's a note regarding earnings reports. The next CAMT earnings report is scheduled for July 29th. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the CAMT July 19 expiration 85 strike call for $25.50. We also reviewed a spread. The spread said to buy to open the CAMT July 19 expiration 95 strike call and sell to open the CAMT July 19 expiration 100 strike call at a debit of $350. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.